Hello, this is Mike Swanson. I run the website WallStreetWindow.com, and the odds are that you're watching this video because you got an email from me telling you that it's up and for you to see on YouTube. Now, if you're not on my email list, click the link you see below this video to get on it, because there's a lot of things going on in the markets this year. Volatility has increased. We're seeing a stock market rebound or rally, whatever you want to call it, over the past couple of days after what was the worst January scene for the markets for a very long time. But today, Facebook reported an earnings report that was a complete debacle. Shares are in fact down 20%. Does this mean the end of the rally? Well, let's step back and look at the charts. Then we'll talk about Facebook in its situation. But if we look at the S&P 500, this is a chart of the S&P 500, we can see that it fell below the 200-day moving average in January, and it's been trading up over the past couple of days. That's brought in a lot of excitement in the markets. A lot of people, as I've been saying, though, there's a lot of problems with the market, internals for the market, meaning most stocks have actually been declining since June. A lot of the exchange traded funds and other indices have been performing poorly, as I'll show you in a few moments. But and we got the bad Facebook news, which obviously could put a damper on things. But the reality is the stock market, a lot of things are broken. So when this rally does come to an end, you know, a lot of stuff's going to end up making new lows. Not everything. Leadership stocks will likely still continue to well, and I'll point one out in a few minutes. But if we just step back from all that, what I said, and look at this, what do you see? I see the S&P 500 got oversold when it fell below the 200-day moving average last month, and it's been rebounding. The daily stochastics, the indicator at the top, it's an oversold, overbought indicator. When it got below 20, it said oversold. When it gets above 80, it'll signal overbought. I still think, even with Facebook blowing up as I'm doing this video, that there is a good chance that we'll get to that overbought reading. That doesn't mean, though, that the S&P has that much more upside potential from here. In fact, I don't really see one trade or another when I look at this chart the way it is. If I was just trading this, I don't see a good buy. I don't see a compelling immediate short signal either. Instead, what I'd want to see is, how does this play out over the next couple of days, the rest of this week, and so forth. So I'm still going to be watching this situation very closely when it comes to S&P 500. So in other ways to put this is, the broad market, when it comes to S&P 500, very tricky to try to make any trade or, you know, really one strong opinion. So what do you do in that situation? You want to stick with stocks and sectors beating the market that are in stronger trends than what you want to see here, and also avoid things lagging, avoid things that when they fall bad, worse than the stock market. When the stock market rebounds, they don't go up as much. And you want to use the relative strength indicator to keep track of that. So to give you an example, here is Exxon, a stock I own, a stock that surged 6% yesterday to a new 52-week high. And as you can see, did not pull back at all in January. You know, you wouldn't know there's all this stock market volatility happening. You wouldn't know any of that if you were an Exxon trader. That's the same situation with energy stocks in general. They've done great. And that's why I have, you know, been, why I continue to hold them. And I've been bullish on them for quite some time. But on stock charts, if you use a ratio indicator, XOM, semicolon SPY, then you have relative strength trending up. When you have relative strength strongly trending down, that's a situation to get out of. because stocks that lag the market, when the market pulls back, tend to fall bad, and they can be prone to violent drops regardless. An example is Robinhood. That stock, the relative strength indicator was going down, 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 down since August, and it had a horrible earnings report. It's bounced, but if that gets above 80, that's frankly a time to sell, or even a time to short the stock and bet against it. Because when you're in a market with a lot of stuff broken, a lot of stuff in bear markets of their own, then there are short selling opportunities. Another example of such a situation is Rivian, lagging the market, and then it crashed in January. It's rebounding and not doing as well. But look, this is the same story for the ARK ETF. So wow, the NASDAQ did have a big bounce, and hopefully it'll continue. We'll just see if it can digest the Facebook news and how much damage that does. Doesn't matter when it comes to ARK ETF. The ARK ETF was down 5% today when the NASDAQ closed today up. That's bad. The ARK ETF has been lagging the market now since February, and it had a horrible January, and it's traded worse than the S&P, worse than the NASDAQ on the relative strength indicator, even since last week's rebound of the NASDAQ and the S&P. Avoid ARK, sell ARK, get out of the holdings inside of ARK. It is a disaster ETF. You want to avoid it. Think about energy. If you want to make money, avoid ARK, or shift out of ARK into energy stocks, commodity stocks, things that are in the real world doing stuff. That means get out of crypto, frankly, too. And things like the coin ETF, another disaster, right? Horrible relative strength, lagging, lagging, lagging. That's the indicator to use to navigate the market for the rest of this year. Relative strength. When relative strength is trending down, get out, or be very careful. Don't buy into those situations. And that takes us to what we got to think about, how these markets truly are changing. Over the past couple of years, we've heard FANG beats the market. FANG pushes the S&P up. FANG pushes the NASDAQ up. But FANG is Facebook, Amazon, Netflix, Google. What happened in January? Netflix blew up. Netflix fell 20% in a single day, and it's a broken stock. Yes, it had a rebound the past couple of days, but it was down hard today, 6%. It's well below the 200-day and 150-day moving average. It's a broken stock. That means one FANG component is broke, and today another FANG component in the likes of Facebook has broken too, down 22.9% as I'm doing this video. Facebook earnings were a complete disaster. Why? Because they reported or blamed their problems on inflation. Now, how inflation impacts a pure internet company, I don't know. Doesn't matter. They're blaming it on inflation. They're saying that inflation has hurt small businesses from advertising. I'm going to talk about that in a second, while that's partly mythical. But it also says users are shifting away from the news feed into things that they don't make as much money on. So revenue wasn't as good, profits weren't as good, and the stock is down 20%. When it comes to the broad market, though, this is the second out of the FANG components that are now broken. And that's a sign that we are in a much different stock market environment than we have been in the last year or even several years. No surprise, it was the worst January ever. Market volatility is extremely high. It is a different situation, one that demands getting away from lagging situations into stuff with strong relative strength. Commodities, real estate, energy, things that have the ability to produce profits even when interest rates go up or the profits go up themselves. But Facebook, wow. And I got to tell you, this is the first earnings report since Facebook changed its name to Metaverse. What does that tell you? That the Metaverse is not exciting people. In fact, the Metaverse may be turning some people off. Who wants to walk around wearing crazy goggles all the time? That's not how I want to live my life. Hopefully that's not how you want to live your life. And hopefully it's not how your children or grandchildren are going to live their lives either. That's not what life is about. And I think hopefully people are turning away from this branding situation. And that's part of why Facebook is down. I don't like Metaverse. And I don't think advertisers like Metaverse either. And so far, it's not helping this company's bottom line. But when they say that inflation is hurting advertisers, I'm going to tell you, I have had my website, WallStreetWindow, on the internet for over 10 years. And over 20 years, time goes by. And I can tell you that Facebook is the worst platform I have ever advertised on. Fake clicks, I believe, or at least they're not as responsive. When they click, they don't spend as much time on the website. They don't do as much. It doesn't look real. At the very least, the traffic generated from the Facebook advertising I had done was not as valuable as what I'd done elsewhere. And I pretty much, over the past year, stopped doing it. And it had nothing to do with inflation. It had to do with that. And there have been scandals where Facebook, as has been revealed, was misleading advertisers, by giving them information about the statistics on their ads that didn't turn out to be correct. So, the fact that people aren't spending as much on there, isn't that shocking? As far as users not using as much, maybe they're fatigued and burned out from a lot of the, stuff that gets on the news feed, that upsets people and so forth. It's a study, look, what have we found in the past year? That people that are children that use Instagram and social media, it hurts them. It causes them stress, social anxiety, eating disorders from being so upset. And maybe people are telling their kids, get away from this. This is not good for you. And I submit to you that Metaverse is 20 times as bad psychologically as all this other stuff. In fact, there have been studies that show that if you wear these goggles and try to do stuff wearing them, that a lot of people just get sick. They get motion sickness. They throw up. It's not good. So the thing that this stock is trading down, shocking, they've had these scandals and they make people sick with their devices, and now the stock's trading down. Does that mean the stock market's going to crash? No, but it does mean that a shot has been taken now with the futures market tonight because of this. And this is a weak stock market that had a big drop on huge volume. Lagging situations are bad, and that's going to continue. Lagging stocks, lagging sectors, lagging ETFs are not going to be good the rest of this year. And the Facebook news doesn't cause that, but it's the underlying condition of the market. So I mentioned ARK as one situation like that, but another is the Russell 2000, lagging the market, trending down, so that's not good. And this rebound, did not change that. The Russell 2000 did not stop lagging on the rebound, neither did ARK. So get out, and I'm actually using these things. Is there's a short ETF now for the ARK ETF, SARK. I've got a position in that now, and there's one for the Russell 2000, two short ETFs. You can look them up and find them, but I got a small position in them too. It doesn't mean I'm going crazy trying to short the stock market. I've got way more long positions than short positions in this market environment. And as I said, one of the stocks I own is Exxon. What would you rather own, Exxon or Netflix? And that, I think about that question and take it real seriously and spend 30 minutes thinking about that. And then you'll have a roadmap on what type of stocks are the best to buy into for the next several years. So another update coming over the weekend. And to get that though, you want to click the subscribe button, then click the bell next to it. And then YouTube will send you an alert when that next video is up. And click, if you would, if you're already a subscriber, the like button, because then YouTube knows, hey, people like this, and they might then show it to other people, because it's very difficult for YouTube people or people like me putting a video up on YouTube to get our word out when YouTube really is putting a higher priority on CNBC and the mainstream media than someone, like me, that's more skeptical about FANG and Netflix or Facebook, not FANG, but Facebook. Metaverse is what they want to call themselves. Get out of the metaverse. Don't get in it if you're not in it. I'll never get in it, and I hope you never do either. And good luck with the markets the rest of this month, and good night.